So, as we're looking ahead to 2026, the global economy is shifting, and it's forcing us to rethink what emerging markets even means. The big question is, are we about to see a whole new era for these economies? Let's dig in.
For the longest time, this quote you see here was basically the gospel. The term emerging market was pretty much code for risk, for instability, and for the constant threat of some sudden crisis. And that idea, well, it shaped how people invested for decades.
So the big question is, does that old stereotype still hold up? Well, the data is starting to tell a very different story. And frankly, it might surprise you. Let's break down what's really going on.
All right, first up, let's talk about the external stuff. You know that old saying in investing, right? Sometimes it's better to be lucky than good. Well, it seems like emerging markets are getting a pretty healthy dose of luck from the global environment right about now.
Okay, so what does this luck actually look like? Well, a few really powerful forces are all lining up at once. First, easing financial conditions is just a fancy way of saying it's getting cheaper and easier to borrow money around the world. That alone is a huge help for these countries and their companies. But then you add a softer US dollar to the mix, even better. And then, on top of all that, remember that a lot of these places are huge commodity exporters. With prices for things like oil, copper, and gold going up, their national piggy bank gets a massive boost. All of this feeds into a key idea called their terms of trade.
So, what does that mean? It's actually pretty simple. Imagine the price of what you sell to the world goes up, but the price of what you buy from the world stays the same or even drops. You're getting richer, right? You can suddenly afford a lot more stuff with the exact same amount of work. It's a really powerful tailwind. But, and this is important, this good luck is only half the story.
And this is where things get really interesting. This is where luck meets skill. See, the real story here isn't just that emerging markets are catching a few lucky breaks. It's that for the first time, they're in a position to actually do something with it. They're better prepared than ever.
And that combination, that's the whole ballgame. It's not just a lucky streak. We're talking about real, fundamental strength being built from the inside out. These economies have learned some tough lessons from past crises, and now they're showing off a whole new level of resilience and, frankly, just smarter policies.
Just take a look at the growth numbers. You've got India projected to grow at a really impressive 6.5% in 2026. And even with all the challenges you hear about, China is still looking at a solid 4.5% expansion. This isn't just some temporary bounce back. This is sustained economic power. And that strength, it's not just at the national level. It goes right down to the companies themselves. A default rate under 2%? That is incredibly low. It's way, way below the long-term average. It's a massive green flag that tells you these companies are financially healthy and they know how to manage their books.
And guess who's noticing? The big credit rating agencies. For the first time in 5 years, we're seeing way more upgrades to a country's credit rating than downgrades. In fact, 62% of the changes are positive. That is a huge vote of confidence in how these economies are being run.
Okay, now this is where those old stereotypes really get turned on their head. If I asked you who's more fiscally responsible, Peru or France, what would you say? Well, if you look at the data, the scale actually tips towards Peru. We're talking lower debt to GDP, a smaller deficit to GDP, and they have an independent central bank. It's a wild comparison, but it perfectly shows how much those traditional lines are blurring.
So this is what we're talking about when we say EM 2.0. It's this new reality where a lot of these so-called emerging markets are showing off policies and institutional strength that can rival and, sometimes even beat their developed counterparts. It's a convergence, and it's happening right now.
Okay, so we've covered the why, right? It's this awesome combination of luck and skill. So now let's get into the what. Where exactly are the opportunities hiding in this new M 2.0 world as we look to 2026?
The first myth we have to just throw out the window is that emerging markets are only about digging stuff out of the ground. Just look at this. A full half of the emerging market stock universe is now tied to technology. So you get this incredible mix of the new economy and the traditional one. You get exposure to everything from AI and semiconductors all the way to oil and copper.
And that dynamic mix, it's fueling some serious momentum. We're not just talking about strong corporate earnings. We're talking about accelerating earnings. They're projected to jump from an already solid 10% growth in 2025 to an even better 15% in 2026. Now that is a growth story you can't ignore. So where do you look for the action? Well, in stocks, China's tech sector is forecasting a mind-blowing 35% rebound in earnings. Brazil is a really interesting one because it gets a double win from lower interest rates and those strong commodity prices.
And then you have India, which just keeps delivering that steady, resilient growth we mentioned earlier. And if you're looking for income, the bond side is offering some really attractive yields. We're talking around 7% in US dollars.
Okay, but of course, no story is all sunshine and roses. We have to take a clear-eyed look at the risks. Because even with this really positive outlook for EM 2.0, there are definitely some potential headwinds out there. So what could throw a wrench in the works? First, if the US Fed gets hawkish, that's just Wall Street talk for raising interest rates aggressively, and the dollar gets a lot stronger, that could slam the brakes on a lot of the good stuff we just talked about. Second, in today's messy, fragmented world, a geopolitical shock could pop up anywhere, at any time. And last but not least, high government debt isn't just an emerging market problem anymore, it's a global problem. So a panic about whether a country can pay its bills, even if it starts in a place like the US or Japan, could create a massive ripple effect that hits absolutely everyone.
Which brings us to our final, and maybe most important question. The old maps of the investment world? They're basically being ripped up and redrawn. That simple, clean line between safe, developed markets and risky emerging ones, it just doesn't work anymore. So as these lines keep blurring, where do we need to look for real growth and stability? It's a whole new game.